Good morning. We're here for another session of Hour 91. Our guest today is a follow-up to our last podcast by popular demand. Ron Ricchio is back from Chicagoland Home Mortgage Services. And today we're going to be dealing with a couple of specific topics that we believe would be of interest to all potential borrowers, but most specifically to many first-time buyers. Ron, good morning.
Good morning, George. How are you today?
We're doing great. We're getting ready here for a big weekend of sports in Chicago marketplace with the Cubs Sox series renewed, and of importance really from the perspective of pride to the White Sox and pennant races to the Cubs, and then following that up with Sunday with a big game for the Bears on the road against Arizona. So hopefully individuals will still have some time out there to take a look. If they're in the buying public, it's a great weekend to be out looking. Hopefully good weather coming our way.
Yeah, hopefully the Bears can pull out another win this weekend.
Yeah, the thoughts are moving in both directions, of course, on the Bears, but I think there's definitely an optimistic feel compared to where we've been over the past few years. Today's topic, again, is a spin-off to some questions that we received from last podcast was, how do I get into the business of buying a house? And many of our first-time buyers need to overcome a few questions, mostly capital, when they're first getting started. Where do I have the money for the down payment? And where do I get the money for the additional costs that are associated with the purchase? Let's address, before we get into the main topic for today, which is the scenario of taking a look at the closing costs themselves. Let's talk a little bit about down payment. Ron, what are some sources of down payment that a first-time buyer might be able to consider to be able to get into that first purchase?
So we actually have some great first-time home buyer programs. There's two specifically. One is a 3% down conventional product, which can be either utilized through Fannie Mae Home Ready is called the product, or Freddie Mac's Home Possible. The Home Possible product that's 3% down, we do not have an income limit if you're buying in Cook County. Most limits are $84,000 for either a borrower or combined income if it's two people that are buying. Then we also have the FHA product, which is 3.5% down. So those two are usually the most popular ones for first-time home buyers in terms of the actual products that we use out there. The conventional product is much more popular if you're buying a condo, because if you're purchasing a condo, you cannot use an FHA product unless the actual condominium complex and association is approved by FHA.
Okay, and specifically for the actual down payment, the cash to be able to have that transaction take place, does that need to come strictly from the buyer, or do they have other alternatives of where they could find the down payment money?
So there are other alternatives as to where the down payment, or where the closing cost, can come from. So the down payment has to come from the borrower, or it has to come from a gift that the borrower is receiving. That cannot come from the seller. But the closing cost on a purchase can come from the seller. So let's just give a simplistic example. Let's say you're buying a $200,000 property and you're doing 3% down, which is $6,000. That money would have to come from the buyer, either from their own savings, or if the buyer was getting a gift from a family member, that is allowed. Now, typically the closing cost for a transaction, just in general, are usually around $6,000, and we'll break that up here in a moment. But that $6,000 can be a seller credit to cover to cover those costs, or we can also get a lender to cover that money, that cost at the time of closing, or a combination of the two. So there are different ways that we can get people into a property with just using their down payment of 3%, and then having the cost either picked up by the lender or by the seller, or a combination of both.
So with a creative mortgage company such as yours, and with a creative broker, hopefully one of our agents working at our Weichert Realtors All Pro company. The down payment scenario or the cash scenario is one that can be overcome under several circumstances.
That's
Correct?
correct.
All
That's
right.
correct. And it's always a big concern for buyers. Usually, the biggest obstacle for them is not so much qualifying for an actual mortgage, but do I have enough for a down payment? Do I have enough for closing costs? So the actual capital needed to actually get into this is their biggest concern.
Good, good. That's good to hear because, again, individuals that are evaluating their scenarios on purchase are oftentimes they're looking at their current rental scenario, and many times the cost of purchase could be the equivalent of what they're paying, or very close to what they're paying in rents today, without the benefits of appreciation without the benefits of equity buildup by pay down of the mortgage. But many times they just don't know if they have enough capital to be able to pull it together. So with good earning power, there's ways to be able to put that together then, and that's good news.
Correct.
Okay, good. Let's break out some of these costs specifically so that we can be of good information, provide good information to the buying public out there. In general, the generic name closing costs for a transaction kind of gets tossed around, and sellers have closing costs to sell a property, but buyers also have closing costs to be able to acquire that property, which you just referenced a little bit earlier today. Uh, Many times they have another name too, origination costs, which is synonymous with closing costs, correct?
Correct.
Okay, good. Let's get into a breakdown then, Ron, of some of these costs that the individual should know about and can find out about and would actually be documented so that they would have full knowledge of that before they would be signing off on any transactions. Correct?
So cost, and I threw around the number before that closing costs are approximately around $6,000. That's an approximate figure because as the price of the home goes higher, those costs will increase with that because title charges will be higher, insurance costs will be higher. But let's go back to the $6,000 figure that we talked about before. So initially, you have around $450 to $500 for an appraisal fee that's paid directly to the appraisal management company that does the appraisal through our company that we work with. And then most lenders also have what's called an underwriting or an administrative fee, which is usually between $800 to $1,000. On top of that, you're also going to have what's called title charges. And title is typically ordered by the seller's attorney. And title is when they run a search on the property, basically from the time that the buyer is buying it, looking backwards in time to make sure that there's no liens or any encumbrances that are on there. If there are, those are going to be paid and satisfied at the time of closing. And then they're going to insure that search. That's why they call it title insurance. And they also charge what's called a closing or escrow fee. So they also charge the buyer to go to their office to sign all the final paperwork. So all that between the actual search, the insurance, and the actual closing fee is typically around $3,000 that the buyer can pay. Now the buyer can actually shop for this. They can actually, per the TRID guidelines, can actually shop for this service if they think that they're being overcharged. But typically, most times they don't. Most attorneys keep this in line, and it makes it a lot simpler for us. On top of that, you also have a homeowner's insurance policy. So when you're buying the policy, when we close, the property has to be insured in the event of a loss or a fire. So depending upon who the insurance company is that's selected by the buyer, Allstate, State Farm, or one of the other companies that's out there, you could be paying $800 to $1,000 for homeowner's insurance or more, depending upon your coverage. And then finally, we have an attorney's fee, which typically can be anywhere between $500 to $800, depending upon who the attorney is. So that all together is, if you add all that up together, is around $6,000. There could be additional charges if you buy in a city or municipality that has what's called a transfer tax. Now, the city of Chicago charges $7.50 for per every $1,000 to the buyer for a transfer of direct revenue tax directly to them. So for every $100,000 that you're buying, you're going to spend an additional $750. So for this scenario, the example that I gave of somebody buying a $200,000 purchase in the city of Chicago, $6,000 in closing costs, you would have to add an additional $1,500 in closing costs, or 70, now bringing it up to $7,500, because there's an additional transfer tax in the city of Chicago.
So the sticker shock when you're working with first-time buyers, can you describe that experience if they have not been properly prepped along the way?
Yes, yes. So they do experience some shock when they look at the numbers. So sometimes they look at the numbers and say, "Well, our closing costs are more than the down payment," and that can definitely be the case, especially if you're buying here in the city of Chicago. Now, one thing to keep in mind is that most municipalities do not have a transfer tax, and the ones that do typically are lower than the city of Chicago. So, like I said, we try to do our best here to accommodate the buyer by having the seller pick up some of those costs, or maybe the lender pick up some of those costs, or a combination of both. Usually, there's a 3% cap on what the seller can pay for closing costs for the buyer. So if you're buying something that's $200,000, they're going to cap us at about $6,000. So in this scenario, if somebody was buying in the city of Chicago and spending $200,000, where we had $7,500 in closing costs, we could get a $6,000 closing cost credit from the seller. We could get another $1,500 from the lender, and then the buyer could be just coming in with as little as 3% down, or $6,000 to close the transaction.
If the lender participates as part of the credit process, then is there a slight adjustment on the interest rate to reflect that credit from the lender?
There is. So the lender will begin to give credits as the interest rate moves up. So let's say today we're at an interest rate of 4.5% without any credit from the lender. In order for the lender to give a credit at closing, the interest rate would have to be increased, let's say to 4.75 or 4.875. And the theory behind that is that the lender is going to be making more interest on a month-to-month basis. So they are going to help the borrower to get into the property by providing them a credit at closing to help them cover some of the closing costs.
Okay, that's good. Good to know. And from the perspective of the buyer, as they're taking a look at the individual costs, how does this all fit into the process of your initial interview with the buyer and getting them qualified along the way? And how do these costs get laid out so that they know what the exact costs will be, or at least an estimate on those costs?
So typically, when we either meet with a client face to face, or even a conference call over the phone, we'll typically put together what's called a loan estimate, where all of these charges are laid out, and we'd like to go through each one of these with our customers, basically line by line, so that they understand, because it can be a bit overwhelming to see these high costs for a transaction like this. So we'll put together a loan estimate, and we'll send it to the buyer prior to doing their pre-approval, and we'll go through all these numbers together, and we'll go through different scenarios as to how they can have this picked up either by the lender or by the seller, or a combination of both. A buyer can also pay for that for themselves out of pocket if they have the additional funds, but a lot of times they would rather not, and they would rather have this picked up either by the seller or by the lender.
Good. And what's the appropriate time? Oftentimes, a contract gets signed already by the time you get to see that borrower. If you had your druthers on structuring the transaction, what's the best way to approach it so that the buyer has a good feel for the process?
So in terms of that, I mean, we always like to talk to potentially the agent, if the agents talk to us in regards to how much of a credit that they can give. But we always try to see if there's a possibility that the agent can put in for closing cost credit to help out the buyers with their closing costs, especially in a minimum or a minimum down payment scenario or situation. So we like to converse and have some communication with the agent prior to putting in the contract, and then be able to offset some of these costs through that closing cost credit for the buyer so that they have less money that they need to bring to closing.
All right, that's great. And I think it's important from the brokerage perspective. As I said, we're negotiating contracts all the time on behalf of buyers, that be taken into account where at all possible in the upfront negotiation between the parties, because we will go if we're representing the buyer, we will go to the seller's agent with the offer, and then that offer will oftentimes include that closing cost credit up front. And then eventually the parties go down their merry way to coming to a negotiated price with or without the closing cost credit in there. And then at that point, while not cast in stone, it's still a scenario where you've already done a lot of the legwork to get to that point, and reopening negotiations at a later point can be sometimes problematic. Ron, could you comment on one scenario with the closing cost credits involved in the transaction and how that impacts the appraisal on the property? Because that is a good question, I think, that borrowers would like to know.
Sure, of course. So as you know, if somebody has a closing cost credit that's in the contract, that means that they're most likely paying a higher price for the property. So if you have a let's say a listing price that's 200,000, and somebody comes in with a 190 offer with no with a $5,000 closing cost credit, it's really as if the property was sold for 195. So the concern is that when you have a closing cost credit, you typically have a higher sales price. Is that going to impact the appraisal? So the appraisal has to come in at the contract price if there's a closing cost credit. It has happened, not too often, but it has happened on a few occasions. Probably less than 10% of the appraisals that we have may have a valuation issue. But sometimes if there is a closing cost credit and the appraisal comes in below the actual contract price, the attorneys will go back and renegotiate a lower price without the closing cost credit, or reducing the closing cost credit if there was an appraisal issue.
Okay.
But for the most part, George, we have not had many appraisal issues, even if there's a substantial closing cost credit from the seller.
For the most part, the appraisal process seems to have been in a scenario here with appreciating prices that we've had over the last 3 to 5 years, a lot less appraisal issues than you might have encountered when the market was in disarray in the 2009 through 2011 timeframe.
Yes,
correct?
very
Okay.
much so. A lot less appraisal issues now than we encountered some 8 to 10 years ago.
That's good, but I think it's always important to be cognizant of that. And for that buyer, one of the ways that the appraiser is going to take a look at the transaction is that they are going to look primarily at the last 6 months of closed transactions for the specific property. So based on the timing of the year, that can have an impact on your appraisal also.
Yeah, it's a great time of year now for appraisals because they've got the last 6 months of a great spring market and summer market in terms of sales that can support some pretty good values here. So it's right now we're probably having the least amount of concerns in terms of appraisals and valuations coming in.
Good. Well, as we close out today's session, we always ask you, Ron, for your impressions of where you think the market is today. No one has a complete feel on where we're going to be tomorrow, but we were discussing a little bit earlier some current statistics that have come in. What's the forecast right now for interest rates, and how is the current job numbers across the board affecting interest rates?
So as of today, we're looking at a 7-year high in terms of mortgage rates. On average, 30-year mortgage rate today is around 4.75, and that's really up from where we were just here maybe just a month ago, where interest rates were probably closer to 4.5. And it was really sparked because of the jobs market, the jobs report that came out in early September. So the first Friday of every month, we get the unemployment report, and that jobs report came in line with expectations. So there wasn't a surprise there, but the wage inflation component of the jobs report did come in hotter than expected, and it was the hottest that we had seen in about 7 years. So if inflation begins to go up higher than expected, we're going to see rates go up, and potentially the Fed will have to continue to increase rates. Now, the Fed is meeting next week. The Federal Reserve has already baked in, or the interest rates have already baked in the fact that the Fed's going to raise rates here next week 0.25%. So our current rates have already factored that in. There may be another interest rate increase prior to the end of the year, and they're currently slated to do 2 next year in 2019. So we are looking for upward pressure on rates right now. Potentially, we could maybe going into 2019 breach 5% if inflation continues to head on this path. But we'll look to see here in the October and November jobs reports to see if that inflation component, that wage inflation component of the report, has in fact calmed down, or if this is definitely a higher trend.
Okay, that's good to know. So, as as always, buyers are in the dilemma of higher interest rates potentially means higher mortgage payments, and they have to factor that into their buying process. There are adjustable rate programs, of course, that might be able to keep the rates a little bit more affordable for them. From the perspective of market conditions, sellers are also impacted by increased interest rates because, in theory, depending on the location of the property, the amount of supply in the marketplace, and the amount of demand, sellers may need to be in a position that they become more competitive with their pricing. So while rates might go up in the future, oftentimes prices may stabilize, although not always the case.
Well, and if this happens to be a blip on the radar in terms of this wage inflation component, to where if next month the report comes out and that wage inflation number is more in line with expectations, then we could see rates come down. And I think this is a very comfortable range in terms of mortgage rates. Maybe while it's not the 3.25%, 3.5% 30-year fix that we saw, 3 to 4 years ago, it is still a very comfortable, historically low range for mortgage rates. And I think if we can keep things under 5%, I think it'll be a nice push here for keeping the market, keeping the real estate market going here, going into the fall and in the winter months, carrying us into spring of 2019.
Great. I think that's a great conclusion for our meeting today. And again, many thanks to Ron Ricchio from Chicagoland Home Mortgage Services. I'm your host, George Ristau, Weichert Realtors All Pro. Let's everyone have a great weekend and a great finish to September and October as we move into the fall marketplace. Thanks again, Ron.
Thanks, George.